Welcome to the weekly update, where I'll go over the action in the market for the week of April 22nd through the 26th, and then we'll see how things look for the week of April 29th through May 3rd. We had an up week. It's the first one we've seen in a while. The market's been under some pressure. We're turning a little more positive on the daily charts, but we're still negative, even in the short term. We have some moving averages that we need to get above, and we need some of our indicators to start looking more positive, but we have been seeing an improvement. We're also showing some weakness here on the weekly charts, but the long-term trend still remains positive for those of you that are longer term. Please be reminded that I also do videos every day, where that's the real backbone of what I do. And then this weekly video is meant to supplement the videos that I do each day. But I know folks are busy and you only have time to do what you can do, but there are other resources that I make available if you find them useful. Before I get started, please feel free to check out the daily videos. I provide commentary and analysis. As we've been going through a more kind of confusing time right now and a more complicated time, I will confess my videos have been longer. I try to keep them at 30 minutes. Then I've been getting up to 40 minutes. I even had another video that was close to 50 minutes. So I apologize for that due to the length, but I don't apologize for what I talk about in those videos, because I feel that everybody needs to be armed with as much information and relevant information as possible, presented in a coherent manner, so that you can use that to help make decisions. Also, I'm in the process of making some program launch videos that just explain the program that I have. And I posted a couple of those videos already, and I will be posting more. My goal is to start the program in June. I don't have an actual day yet in June. I'm in the process of re-recording some of my courses, but please feel free to check those out if that's something that interests you. Also, with every video that I upload, I have a PDF that I post in the description, whether it's on YouTube or Rumble. Some folks find that helpful to download it and be able to look it over. Also, and this is kind of developing into a weekly video, the last video that I do each week is called the What to Watch video. And I don't just look at daily charts. If I go through the charts and I see something on the weekly side that looks more pertinent, or even in another market, I'll bring that into the video. I have a positive list and a negative list, and I go through each one of those things. And it's not the what's going to happen video. It's the, here are the positive things to look at and follow. Here are the negative things to look at and follow. And then possibly with those sources in hand, you are then able to make better decisions. Also, every day I post what are called pivot points on the YouTube community tab. I can't do this on Rumble. You click over into the community area. I have some questions that I ask each week with a poll. Then every day I post a daily video, and those pivot points last for the whole month. And I update it with the most recent bar for that day, actually candlestick for that day. But then I also post an intraday pivot point chart, and those update every day, and they're different. And it's really quite amazing how accurate these are. All the algorithms out there and folks that use different computers to trade with, and even floor traders and a lot of folks, you'd be amazed at how we're going up and we hit one of those pivot points and that's right where we stop, or we're going down, we hit one of those pivot points and we actually start going back up. It's really amazing how they work. And I found that the 10-minute bar chart with the pivot points on there is the most helpful. You can have a 30-minute chart, a 60-minute chart, but the pivot points are calculated in a slightly different way. Also, I do have a private Facebook group, not really active there. I pretty much just post now whenever I upload a video. And I will be going through the results of the latest poll, and then I'll be posting a new poll for the upcoming week. I do really watch YouTube and Rumble comments, especially on Rumble. I'm apparently that webinar thing that was going to make all these people YouTube experts, apparently that's done now. And so I haven't been getting a lot of those. Who knows? It may pick up again as they do another webinar or something. But I get these comments where people are not even watching the video. They're just telling me how great they are and how terrible my channel is and how life would suddenly have meaning if I was to hire them as a consultant. I'm not interested in that. So I get rid of those comments. Any crap comments that come in, those get deleted. If you have a legitimate back and forth, whether you agree or disagree, whether you want to take me to task for some way that I interpret a chart, I have no problem with that at all. That's what this is for. But I want it to be honest back and forth dialogue with each other. Also, I post not only on YouTube, but also on Rumble. Here is the link. It's also in the description. And sometimes I have some uploading problems. If you can't find me on one platform and you think there should be a video available, please feel free to go and check on the other platform. All right, let's go back and talk about what happened. So we were up 2.67% for the week, and we were above average with volume. We haven't been seeing above average volume lately, especially on the daily side. It's starting to pick up. More folks are getting involved in what's actually happening in the market right now. We are positive in the bigger picture, especially when we look at our weekly charts, but we are showing some weakness. We were going up and pretty much not showing more than just a slight pullback. Well, now we ran into some more difficult times, and so our charts are reflecting that. So we want to be aware of those things. Even though we are showing some improvement on the daily side, we have a really big week that's coming up with some major economic reports and a lot of earnings that are being released. And taken all together, that can really whipsaw the market either higher or lower. And right now, on a more of a macro basis, a bigger picture, it's about inflation and interest rates. We're going to have the Fed meeting this week, and they're probably not going to raise rates. It's going to be what they say in their statement. It's going to be in that report that's released on this scatter plot thing to see how many rate cuts they're actually looking at possibly doing. It had been 3 last time. If that gets cut down to 2 or 1 or none, that could really spook the markets. If those 3 potential rate cuts are still there somewhere, but maybe pushed down the road a little bit, the market could react to that in a positive way. And then we're dealing with earnings season. We're right at the height. We had over 40% of S&P 500 companies report this past week. Well, we still have a lot of companies that have yet to report as well. And then after, I should have done this before, after the Fed gives their press conference, or after they make their statement, then there is a press conference. And that's what Jerome Powell, he's going to come out and say some things. The markets are going to try to dissect not only what he says, but how he says it. And the market will gyrate as it tries to figure out what's happening there. Our trend right now is a weakening trend. We've fallen below the moving average, and I'll show you a chart to back this up. It is still positive. The green line is on top, but it is declining, and the red line is starting to come up. So we're going to need to see more than just one positive week to kind of turn our bigger picture to looking a little more positive on a trending basis. So for the week, stocks did rebound, and it was a very busy week. We had a lot of earnings reports. We had a lot of economic reports that came out, and I go through those in more detail. I don't dissect them in the daily videos, but I do discuss them, and I show you charts when they are relevant. And then nearly 40% of S&P 500 companies did report earnings this past week. That means there's 60% or so. A few have already reported above the 40%, but there's still a majority that have yet to report. Interest rates for the 10-year, we ended up closing at 4.67%. That shows that we're going up with interest rates, and the dollar also rose this past week. Both of those have been pressuring stocks. And another thing that I usually don't really talk about all that much is the 2-year note. It's up at 5% because we have inverted yield curves. So the 10-year is giving a lower yield than the 2-year. And that 5% is kind of a magic level for the market. We did hit that last October with the 10-year, but that's where we bottomed with bonds based on price, and we topped out with interest rates. We started to come back down with interest rates, and that's when stocks saw a really nice move going into the end of 2023. But we are seeing a gradual upward move with interest rates, and that can really pressure stocks. And then Meta, or Facebook, as most people know it, it fell 7.9% for the week. They came out with an earnings report that was really pretty good, but they didn't really like what they were saying going forward. So the market just ended up slashing Facebook or Meta. And then Tesla came out with their earnings, and it was pretty bad. But Elon Musk had said something that the market liked about more affordable cars or something like that. And so the stock took off. So trying to figure out the logic of what's going to happen here. It's the reason why I don't do earnings plays. But we also had Microsoft and Google. They reported after Thursday, and that's where we got a lot of the strength in Friday's session that was mostly confined to the mega caps. We didn't see real broad market participation. Okay, then we also saw the semiconductor index, or the SOX index, and I do follow that. It jumped 10% for the week. These are very pivotal in the tech arena when it comes to cryptocurrencies and computers and so forth. And then we did get the advance. So that's the first reading of first quarter GDP, the first time we had ever seen this number. But this kind of freaked out the market. We ended up gapping lower. After Tesla came out with their report, we were going to gap lower anyway. And it didn't help things when GDP came in weaker than expected, but inflation was stronger than expected. And so now everybody's going, stagflation. Oh my gosh. That's the kind of an environment that we had in the mid to late 70s, where we see massive inflation and little to no economic growth. And a lot of people are already declaring that we're going into stagflation. And we might do that, but just one report does not make what's really happening. We're going to have to see this unfold over a period of time. And the way I look at things, we'll know ahead of time. We'll see what the direction is going overall. But it's, in my opinion, too early to make some kind of a dogmatic declaration before there's really any evidence to suggest that. On Friday, we did get personal income and spending, and there's a really important inflation component in that. And it came in as expected across the board for the whole report. But because it came in as expected, it's showing that inflation is not continuing to go down to that 2% level that the Fed really wants to have happen. So looking at the different indexes, where the Dow was up 0.7% on the week, the NASDAQ was up 4.2%, the S&P was up 2.7%, and the small caps is represented by the Russell 2000. This was up 2.8%. I've been showing this for almost a year now, and this is what we're watching for, where we show this blue line, which goes from 1966 to 1982, very long-term chart. That's why I haven't worried about updating it, because we're just kind of still coming down. But even when we were coming down in 1976 into early 77, we still had blips up along the way. And that might be what we're seeing now. We're seeing some CPI numbers that are stronger than expected. PPI came in a little bit weaker than expected. And then we had the core PCE and then the inflation component in GDP, which were stronger than expected. And just to make a declaration out of that, okay, we might end up going in that direction, but we need more evidence first. But even during this time, when inflation was coming down, it did tick up. It didn't come straight down. The thing that I'm really watching for is if we do get into stagflation, then we're going to see something like this blue line going from the mid 70s up to about 1980 or so. That's when inflation just goes through the roof and we're not really seeing any economic growth. And like I said, it could develop into that. We just take this day by day, week by week, analyze things, and come to the best conclusion. I don't make forecasts. I do look ahead and I see what's happened before, and I use technical analysis, which shows us what's already happened. But about all we can do is analyze where we're at right now. And then on Monday, I'll come back and I'll reevaluate things again. And then I'll do the same thing on Tuesday, Wednesday, Thursday, Friday. And then a week from now, I'll do the weekly video again. And that's pretty much all we can do. To try to interject out into the future, it's like predicting the weather in the latter part of July at a certain time of the day. I mean, you could be right, you could be wrong, but I've just found that trying to project things out, folks love to pat themselves on the back when they even get close to being right. And then they talk about it in such a way so that they really can't be wrong. And then it's just, I think it's crazy. I would rather look at charts and come to my own conclusions. And when I'm right, I get to reap the benefits of that. When I'm wrong, okay, I have to take responsibility for that. All right. We did close at 4.67% for the 10-year yield, which is above the 4.02%, according to RenMac. And this is a chart I've been showing for a long time. When we get above that with the 10-year yield, that's when it starts biting into corporate profits. And we're seeing some of the revisions actually coming down as a result of higher interest rates. Here's the poll results. The first question, the S&P is slightly above its 100-period moving average, and that ended up providing support. We were able to bounce up off of that. We didn't quite come down to it, but we got kind of close to that area. Do you feel that this will hold, or will it possibly continue down to its 200-day moving average? A week ago, we didn't know what was going to happen, and we still don't know what's going to happen in the upcoming week. But for right now, the 100-period moving average, and I say moving averages because I have a simple and an exponential moving average plotted on the same chart. 30% thought that it was going to hold. 40% thought that we were going to break it. And we just, instead of really slowing down at the 100-day moving average, 30% thought that we were just going to slice right down to the 200-day moving average. Well, it held for right now. Then interest rates in the US dollar index continue to climb, and they climbed this past week too. Do you feel that this will continue? The folks that did answer, yes, and they ended up getting that right. Do you feel that geopolitical events in the Middle East, which seems to have calmed down, and it never really calms down in the Middle East, it just gets to more of an okayness that's going on where folks can still kind of go back to their normal lives, realizing that it could re-erupt at any time. And do you feel that it will have an impact on the week that we just ended? And folks were right. We really didn't see much of an impact. 63% thought that there would be no real impact. And then stocks had another rough week a week ago. Do you feel that the decline will continue? There will be a bounce. 45% thought that we would continue to decline. We were up. Bounce, that ended up being what happened at 27%. And also 27% thought that we would pretty much end up flat. No, we ended up having an advance for the week. Some Isabel net charts, and I've been showing this in pretty much all the videos that I do. But if the Fed is capable of coming in and cutting rates, we're seeing inflation under control, and they cut rates because we're getting close to that 2% level that they're trying to shoot for, that would be positive for the market. And that's adjusting to what's going on economically. And that's called a slow cycle. And that would be positive for stocks. If they have to come in and cut rates because the economy is falling apart, because inflation is really headed towards stagflation after all, or there's some kind of catastrophic event that occurs, that's a whole different scenario, and that's called a fast cycle where they're reacting to something, where the slow cycles are trying to anticipate things and kind of fine-tune things. That ends up being more negative for stocks. So we just have to look at the context of where this will happen, if in fact it does start to happen. Here are the earnings forecasts going out, and they're all pointing up. So, and that's pretty much what we see going into 2025. And that's what you find is looking the further out, economists or analysts, I should say, they're very optimistic about what's going to happen in 2025. As it gets closer, now they have to refine that more and more and more, and typically they'll have to refine that downward. Then looking here, U.S. Treasuries are oversold again. This is looking at them based on price, where we're coming down well below its 200-day moving average. This is actually a detrended chart where you measure how far away something is from a moving average. And we did become really oversold in the June to October 2022 period. And then we saw a little bounce up there. We were also oversold again in October 2023. That's when we hit a bottom. And now we're starting to come down to this level again. And it's like, okay, if folks do start to come in and buy bonds, that will push interest rates down, because as bond prices go up, interest rates fall. As bond prices go down, interest rates go up. Then looking at the fourth year of a secular bear market in bonds follows a 40-year bull market. Okay, and I'm sure most of you remember what it was like back in 1790, back here, what interest rates were doing. Yeah, this is a very long-term chart and going back pretty much to the beginning of the country. And so possibly we could be seeing something that is looking better in the longer term, but it hasn't really started to develop yet. And then global housing prices. I keep an eye on housing prices, and then I look at them internationally as well, because that's such a big part of people's wealth. And you can see Australia, my gosh, they're up 9.9%, where US houses overall are up 6.6%. This is year over year. Then we have New Zealand, the UK, Sweden, and poor old Canada. They seem to be falling there. But housing prices, for the most part, continue to go up. They might be able to get a good deal in Sweden now. And then looking at core PC inflation month over month and then annualized out from there. That's what they do with these things is we look at what was it compared to last month, and then we, in a way, kind of multiply it by 12 to get an annualized rate where it was higher than expected. Where this is what they're shooting for here, the more average of what it's been over the last 3 months. And the last three readings that we've had have been above this light blue line here. And that's what's causing some concern in the market. Then FactSet, they had three different posts, which sometimes they get one, most of the time we get two. To have them have three posts is kind of strange, but we're right in the middle of earnings season here, where it looks like this was first of the first post earlier in the week on the 22nd, where it says the Magnificent Seven, the top contributors to earnings growth for the S&P 500. And then they did something kind of strange here. Well, they talk about the Magnificent Seven, but then they pick the top five. Okay, well, why don't you just say top five instead of Magnificent Seven, where they have NVIDIA, Meta, Microsoft, Google, and then Amazon. And this is what they're contributing as far as to earnings growth. And this is taking it more altogether. You take all five of those together, what their growth is compared to the rest of the S&P 500. Then in their next post, this is the same post, actually. This is just a different chart where we compare Amazon, Google, Meta, Microsoft with the rest of the market. And this is what it's looking like for the first quarter in 2024. Those are the earnings that we're getting right now. Then you go out, you start looking at forecasts and see how things suddenly look a little more rosy, both for the big stocks and for the rest of the market when taken together. This is their second post. They were looking at energy and looking at the first quarter here where they're down. And this is the third largest earnings decline of all the sectors. Well, there's 11 sectors. So energy's been doing really well based on price. It's leading in some of the areas of the market, but their earnings aren't really showing, at least what we're seeing as of yet. They're not really coming through, but looking out, a little more positive for the second quarter. Then they turn negative for the third and fourth quarter. And then they turn positive again when we get into 2025. Then this is more convoluted. I'm just going to read through the part that's underlined in red. This is the earnings update. And as of Friday, 46% of S&P 500 companies have reported for the first quarter of 2024. And of these companies, 77% have recorded actual earnings per share above estimates. And then you find that they lowball it and then hoping to get some kind of positive reaction from the market. Yeah, that didn't really work so well for some of the companies, but it does work for other companies. And then if you want to just pause this and read through the 5-year, 10-year average, it's kind of convoluted to me. All right, let's get into our charts. Here is the 5 days that we just finished, where we did see an upward move in Monday's session. Things were showing some improvement. If you watched the what to watch video a week ago and the videos that I posted a week ago, there were some positive things that we were clinging on to, and we still are clinging on to a lot of those things, but we saw some follow through to that in Monday's session and then again in Tuesday's session. Wednesday, we were pretty much flat. Then we had the GDP report come out and Tesla with their earnings. We gapped lower. Now you would think, oh my gosh, what a terrible day. But we clawed our way back. We spent most of the day coming back up. And so I see that as more positive than negative. And then after Microsoft and Google reported, and we had the core PCE inflation report, we gapped higher. We were actually about the same after the inflation report came out. It was really Microsoft and Google that, because the futures spiked up right after the close on Thursday, and that pretty much held going into Friday's open. And we didn't see a lot of movement after that, but we did end up closing near the high for the week. This is just the 5 trading days for the indexes, where we saw the NASDAQ and NASDAQ 100 doing the best, followed by the S&P, and the Dow was virtually unchanged on the week. Then this goes back to the beginning of the year, where we have small caps that are negative. The NASDAQ 100, S&P, NYSE mid caps, and the Dow, they are positive going back to the beginning of 2024. Looking at our different sectors, I sorted this according to what was up the most, where tech was up the most. It got hammered the most a week ago. Now it's making a bit of a comeback right now. It was up 3.79% on the week. And discretionary saw a pretty good week too, up 3.62%. It's been a real laggard and a real sign of disappointment. And Tesla's connected to discretionary. And then industrials were up and the real estate sector was up. And then there really wasn't anything down from Friday to Friday. All of the sectors ended up being positive. Then on the next chart, I go over to the last column, and this is a scooter score. The closer to 100, the better looking that sector. We don't have anything in the 90s right now. We have financials, industrials, and communication. They're in the upper 80s. And then way at the bottom, we have real estate, which is in red, and that's still not looking very good. You have rising home prices and rising interest rates. Even though we're seeing some pretty good data coming out of the housing market, this is causing some problems because the real estate sector, they look forward and they're afraid that things are just going to develop into some problems. Then we look at the relative rotation graph. And I always have to say this, remember back to your geometry class, the flat line is an x-axis. The up and down line is a y-axis. Those things that are in the right rectangle, those are the most positive things. That's a plus plus, a plus x and a plus y. In the lower left-hand corner, that's a minus minus. These are the things that are really lagging. And we see real estate, we see, and this goes back over a year, discretionary and healthcare. These are more defensive types of things, except for discretionary. We'd like to see that doing better. But we still have where the industrials are doing the best and the financials are showing a little bit of weakness here, but they're doing pretty good. And then communication, which had been a stronger area, it's been pulling back lately. It's still figuring in that decline that we saw a week ago. Then I look at the different major markets and also compare it to the Wilshire 5000, which is a pretty good broad market measure where we have the mid caps looking better. Now, I pointed out something in the past week that I don't know if it's true or not, but the more I look at charts, the more I'm convinced that maybe there was something behind this. When we were going down, we hit a pivot point with the mid caps and bounced up off of that. It also ended up being kind of close to the 100 period moving average for the S&P. And there was something else that happened around that same time that I can't remember right now. Well, the mid caps, they've been a little stronger area. Now, you would think that the large caps and the mega caps, that they wouldn't get their cues from the mid caps, but maybe they did, because it's one of the stronger areas over the last year where we have the S&P and the S&P 100. They're showing some weakness, but they're still looking okay. We have the NASDAQ 100, which now has been showing some weakness. And then we have transports and the Dow Jones Composite and small caps, which continue to show some weakness as well. All right, then looking at the sectors, this is just for the 5 trading days. We had discretionary and tech were up. All the other sectors ended up being down just for the 5 trading days. Now, if you go Friday to Friday, you're going to get a little different results. But if you just go through the 5 trading days that we just finished, it's going to look a bit different. And then going back to the beginning of the year, where we have energy still doing quite well, that's the leading sector, followed by communication, industrials, and financials. Then the rest of the sectors are now negative going back to the beginning of 2024. Sentiment ticking up just a little bit here. We came in at 42. To give us some context, we didn't get down to 25. We could still turn and go down there, but now the context is a little bit more positive. We bottomed a few days ago and sentiment has been starting to go back up. We tend to ride with that until it gets to an extreme positive above 75 or extreme negative below 25 reading. That's when we look at using this in a contrarian manner. But as it's going up, that's helping improve our outlook on the market. And looking at the active asset managers, they had been very, very positive on things. The latest reading has them down to being more neutral with their current outlook. And even though these are professional money managers, they're still human beings. They have peer pressure. They have people they have to answer to, including their customers. And so if there's some high-flying stock and they're not in it, they may have to chase that stock. Or if there's something that's really going down, they may want to hang on to it, but they may have to sell it just to make it look a little bit better. Then here's that same reading. We came in at 59.48. So we're pretty much neutral right now. Then looking at the VIX, since we had an up week, we came down with the line chart, and we're also coming down with the bar chart. So we're not showing as much fear right now in the market. The Ulcer Index is continuing to go up. We're still getting a high reading above the moving average on the daily chart. It's going up just a little bit here with the weekly chart. Then we look at the Ridex Bear Bull ratio, and look how people freaked out. This is Thursday. There's a 1-day lag on this chart. This doesn't take Friday into account. We won't get that until Monday. But this was people reacting to the decline that we saw on Thursday. And unfortunately, we had a solid update on Friday. So they're ping-ponging back and forth and doing exactly the wrong thing at the wrong time. They would be better doing the opposite of what their emotions are telling them to do. We did see a real drop off in the Investors Intelligence Survey. We're back down to neutral. We had been above 4, then we dropped a little bit below 4. Now we're getting in here to the 2 category. So not extreme at this time. We also had the latest reading from a week ago from the American Association of Individual Investors. They actually dropped below 0. And now that's us. That's you and me. We are individual investors. And taken together as a group, they're turning more negative, but the 50-period moving average continues to go up. And this is actually positive, where you look at 1 to 3 month T-bills, which is cash, and you compare it with the tech sector. When this is going down, that means the tech sector is outperforming. And you can see the problems that we ran into in 2022. Well, we were starting to go back up a week ago. Well, in the latest reading, we're coming down slightly as the tech sector has been improving. Looking at the economy, we have a new quarter for GDP now. So now they're starting to predict what's second quarter GDP going to be. And right now, they're basing it just a little bit under 4% with the GDP Now estimate, where the consensus top 10, bottom 10 is about 2.5% to the upside. And I don't know, what is that? A little bit under 1% to the downside. Then this looks at it on a bar chart. And now we have the second quarter, which will now be included as part of these charts. This is what we're trying to deal with right now. This was the advanced GDP that we just got. And then there'll be like 3 more reports that come out until we get the final number. And then they could come back and even revise that well into the future. Then here is the spread between risky and not as risky bonds. This ticked down just a little bit. It has been coming down overall. If this was really going up, that would cause us a lot more of a concern. Looking at the National Financial Conditions Index, we're declining and below the black line. That is positive for the economy. This hasn't been updated since April 5th, the real-time SOM recession indicator. We're below the red line. That's the important one. And then this hasn't been updated since April 2nd. The smooth U.S. recession probabilities is still below the red line. And then the Brave Butters, that was updated April 1st. That has been declining. And then looking at inflation, where we're starting to see a little bit more data here as we're going into the new quarter. This is the estimates that change every day for CPI inflation and core PCE inflation. Those are the big ones that the market really pays attention to. And we're just looking for weird spikes, either up or down, just little adjustments. That's what the market is figuring at the present time. Here's the Fed. Now they're going to be meeting this upcoming week, May 1st. And they're going to make their announcement. And right now, there's a 97.6% chance that they're going to leave rates unchanged. They're currently at 5.25 to 5.5, and that's what the market thinks they're going to be after Wednesday's meeting. Actually, the meeting is Tuesday and Wednesday. They make their announcement on Wednesday. And this is getting a little further locked in now. As you can see, this is the dark blue. That's where we're at right now. Day ago, week ago, month ago. This is getting higher as we're getting closer to that meeting. Now we start looking at the next meeting after this, which will be on June 12th. And there's an 88.9% chance that they're going to leave rates unchanged at that meeting as well. And this is where we've seen more of a bigger change, where right now, day ago, week ago, month ago, see how not a lot of folks were thinking that they were going to keep rates the same. A lot of folks were in this camp that there was going to be a rate cut. Now, with these stronger than expected economic reports, we're seeing it look like that they're going to leave rates the same. Now, when we're going to get really nervous is if we start to see percentages of these ratings show that there might be a rate increase. because the economic reports are too strong. We're not really seeing those yet, but we're just keeping that in the back of our mind for right now. This is the Fed balance sheet, which as you look at it, it continues to decline. On a year-over-year basis, it's going up a little bit, even though it's showing negative values here. So we're seeing pretty much what the Fed said they would do according to their balance sheets, these are updated once a week. Looking at our charts here, where we came down a little bit with the advanced decline line based on price and volume, but we're still above the moving average. We showed a little bit of weakness on Friday on an up day, and that's a little concerning, but we've been seeing a real improvement on the daily charts as well. That's one of the areas of hope that we've been latching onto. We're also seeing an improvement with the new highs, new lows. This is more of an internal measure that we look at, where just if you look at the blue, my goodness, if you look at the green and the red, there were a lot more new highs this past week than there were new lows. And so we're starting to turn up, but we're negative with our 4-week moving average, and we're flattening out with our 10-week moving average. But overall, even though we're seeing a contraction of the new highs, we've been going lower, and we're not really seeing an expansion of the new lows. And when we did see some bounce going on, we're seeing more new highs being generated. So that is more positive. The advanced decline ratio still above 0 and was pretty much flat this week. That's positive. Accumulation distribution is above the moving average and going up. We are seeing a bit of an improvement on the daily chart. It's just getting back up to its moving average now. It needs to cross above it and continue to go up for that to turn more positive. And looking at our trend, this is what I talk about when I say we're in a weakening trend. The black line is the ADX, and it's dropped below this moving average. Now, I put the moving average on here. I put that on there to give it some context of direction. And so when we drop below the moving average, that tells me that we're in a weakening trending environment, but we're still in a trend because we're above 20. We're still in a positive trending environment because the green line's on top, but it is coming down. So if we see further weakness, we could see some more deterioration with this chart. Looking at the Arun, the green line measures the buyers, which are dropping off. The red line measures the sellers, which on a weekly basis really haven't showed up. So we're looking positive. We're above 0, even though we turned down just a little bit with the oscillator. Mass index is not generating a signal. Then we look at our daily chart, and it's kind of hard to see because we got these pivot points and these lines in here. But we do have some overhead resistance. I don't have the 50-day moving average on here, or the 100 period moving average. The 50 is here. It's the 100 that I don't have on here. And so if we go up, we do have some overhead resistance, including the 50-day moving average that we may bump back into. And then looking at the Keller market model, we're looking at the S&P, we're positive across the board in different time frames, where we're still negative in the short term with the mid caps, small caps, and the NASDAQ 100. We're also negative in the intermediate term with the small caps. Looking across the market, where stocks are positive in different time frames, bonds are negative based on price, commodities and the dollar continue to be in uptrends across all time frames. No changes here in the decision point scorecard. We're declining in the short term, positive in the intermediate term, and mixed in the long term. Here's our trend channel. We're still above the midpoint, and we ticked back up just a little bit. We're at 5,099.96. Can you say 5,100? That's really where we're at right now. And that's a nice round number that the financial media likes and the market likes and strike prices for options like and all that stuff. So we're holding up here in the line when you take a bigger picture look. Then this is something just people are probably getting sick of me bringing up this chart all the time. This is a weekly chart of the S&P where we finally broke through this R1 level, and it took some effort to do that. And then we broke down below it when things were going down. We're almost right back up to it. In fact, intraday, we got above this level in Friday's session, but we closed just a little bit below it. And this is the 5110 to 5111 level. And we're just 11, 12 points below that right now. When we look at a 50-week simple moving average, the S&P did bounce back up and the red line's going up. So the long-term trend is still positive. And then with our moving average crossover, we were able to get back close to this 13-week moving average. And this may act as overhead resistance. We're going to need to break through that for things to turn more positive. But longer term, we are still in an uptrend. And then looking at the McClellan oscillator, where it had gone extreme negative, it is bouncing up, but it's still below 0. So it's negative, but improving. And then looking at the summation index, we're declining but still above zero based on price. We advanced but still below zero based on volume. So that's giving us a bit of a mixed picture. And the Swenlin trading oscillator is looking a lot more positive based on price and volume. It actually crossed back above zero. This is another indicator that I really like because it's not moving average based. This is the bullish percent index, and it measures the point and figure buy or sell signals inside of the S&P 500. We dropped below 50. That's negative. Well, the fact that we were able to come back above 50 is turning this slightly back to positive. And then looking at our momentum, we are rolling over with the PMO, the price momentum oscillator. We're going down still based on price and volume, where we're below zero, even though we did tick up just a little bit this past week. So looking at some studies that are based on the price momentum oscillator, we are looking more positive when we look at the percent of PMOs that are rising. We're no longer extreme negative and showing some improvement with the buy signals, and we're starting to flatten out with those PMOs that are above zero. And we're above the midpoint with the percent B indicator here. What this tries to measure is when we close either above or below one of the Bollinger Bands. Well, we're kind of just a little bit above the midpoint right now. And then here's our momentum oscillators. And I have the short-term ones, the slope and TSI, they're starting to go down. The MACD and the PMO and PPO, they're intermediate term. They're starting to look more negative. The longer-term ones are rolling over, but haven't quite, well, I guess the KST has kind of already crossed over negative. So we've been seeing negative momentum on the daily charts, and now they're starting to show some improvement. Now we're starting to see weakness longer term on these charts. So we're getting a bit of a mixed picture. The Chaikin money flow is still negative on the daily chart, but starting to march back up to zero, where it continues to decline here on the weekly chart. Chaikin oscillator still above zero, so that's positive, even though it has been declining. The force index went back above zero. It's also positive now on the daily chart. And the money flow index, we're still above 50 and trying to go back up. So this is still positive. The rate of change, we just going from this week to last week, we had an up week, so we're above zero. And then going back the last 50 weeks, we came down to this red line, which I put in here, which sometimes means that we're getting a little extreme, but we can go farther than this when we're seeing good momentum. It did turn back up with this latest reading. And the RSI, we're still above 50, that's positive, and we're bouncing back up. So this is showing some improvement. The special K, a very long-term oscillator, which still has not turned positive since about April, almost a year. This thing has been negative, April of 2023, and now we're in April of 2024. The daily chart is rolling over a bit, but still positive, where this chart just cannot seem to go positive. The Stoch RSI, which tries to take stochastics and RSI and put them together, bouncing up after being extreme negative. And the Williams percent R came a little bit down below the midpoint and bouncing back up. So this is looking a little more positive. And we're bouncing back up after getting down to 50 with the ultimate oscillator. So that's looking a little better. We're still looking okay here with the vortex. The green line is on top, but it is coming down. We're negative on the daily chart, but we're seeing kind of the same thing, only with the colors reversed here, where the red line's coming down and the green line's coming up, but they haven't crossed yet. We're here, we're actually showing a bit of weakness, but it's still positive. The copy curve is showing that the weekly momentum is still negative. The daily is improving, but hasn't crossed positive yet. We did come down below this 10-week moving average, and now we haven't been able to get back above it. So is this going to provide overhead resistance if we see some more strength to the upside? And we're starting to go back up with our 253 simple moving average of the equity put call ratio. When this is going down, that's more positive. When this is going up, that's more negative, but it's been bumping all around lately. And then we look at the VIX, and then we take a 3-month average of the VIX and do a ratio. This is going up, which tends to be negative. This just means that the current VIX is stronger than the average of the 3-month VIX. And since we've been going up with the VIX, that's putting some pressure on this overall ratio. Then our different charts. We're still looking negative with the Heikin Ashi. We have dark candles. We're positive with the Kegi and actually pointing up. See how we're getting mixed signals here? The Renko is still positive, where the 3-line break is still negative. So, hey, how's that for 50-50? Then we look at the ease of movement, which is declining and still above zero. So it's positive but declining. On top, we have an equi-volume chart, which tries to take volume and price and put them together. We had an up week, so it was green. And the thicker this candle is, the more volume went into that move. And we didn't see any changes here on the point and figure chart, where we are looking a little more negative. As we were going down, we saw some zeros or O's drawn in here after we had been seeing nothing but X's for quite a while going up. Looking at our momentum long term, we are declining. We're still declining in the intermediate term, where we're seeing some improvement now in the short term. 50-day cycle, where we hit that on March 21st. Then we kind of topped out and started to go down. Now, if we're going back up, it's like we're in the middle of the cycle right now. I just use this for information. I don't make decisions around this. Then looking at our Elder's Impulse system, we had been negative with a red bar. Well, with the up week, we switched back to neutral. And then we're still negative, though, here with the parabolic SAR. Now, we did switch back to positive on the daily charts. And so that's looking a lot better, where we're still negative in the longer term on this chart. With the broad market here, we're getting ready to finish out the month of April, where we might be up about 1.5%, and we're up 60% of the time. And this just goes from 2020 to 2024. It doesn't really do much historical here. And looking at just a plain vanilla chart of the S&P, the mid caps and the small caps, where the mid caps have been holding up a little bit better, the small caps are still just causing a lot of frustration for folks. And they don't do well in a rising interest rate environment because these smaller companies have to borrow a lot. They're not flush with cash. And so the more they have to pay to borrow money, the more that's going to bite into their profits. Looking at the Dow, we are in an uptrend, but we're still below this 13-week moving average. And you're going to hear that a lot. The NASDAQ is back up to its 13-week moving average, but still in a longer-term uptrend. NASDAQ 100 getting close to the 13-week moving average and still in an uptrend. There's a look at the QQQs, where we were down last week and we were up this week that just finished. And then here's the anchored moving average. We're still far away from that. The mid caps are coming right back up to their 13-week moving average, and they've been showing a little bit more strength lately. And the small caps still just kind of range bound, a little bit up, a little bit down, not really going anywhere. The NYSE is coming back up to its moving average and showing some improvement and still in a longer-term uptrend. The Wilshire is still underneath the moving average, but also still in a longer-term uptrend. All stocks coming back and starting to go slightly above their moving average and in an uptrend. The biggest software companies, they're dealing with their longer-term moving average based on 50 weeks, which is roughly, well, it's really 250 days, but they equate it to a 200-day moving average, where it's coming right back up to the red line here. So we're not seeing an awful lot of strength in this one, but it's still in a longer-term uptrend. The FANG index coming back up to its 13-week moving average, longer-term uptrend. ARC, and I'm not trying to make fun of this because there's a lot of people that sunk millions and millions of dollars into this, thinking that Cathie Wood was the way to go, and they put their whole retirement in here. But they unfortunately did it right about here in late 2020 or early 2021, when that seemed like a good thing to do, only to see a lot of that evaporate afterwards. And even when we've been bouncing in 2023, ARC is not really participating. But when we were going down, it was participating in that, but it was up almost 5%, but it's still coming back up to its longer-term moving average. However, it's still in an uptrend. And then looking at the banks, we're keeping an eye on those. They were up on the week, so we saw the RSI going up. The momentum is trying to cross negative, but if we see more follow-through, this could turn back and go positive, but it hasn't done that yet. Then we are seeing money coming out of banks in the latest reading. I just went back 1 year instead of having this massive chart that's really hard to read. So we want to keep an eye on this to see. This kind of tells us if there's confidence or not a lot of confidence in the banks. Then I just look at a weekly chart of the Dow, the transports, and the utilities, where the Dow's have been holding up the best. The transports have been going sideways. The utilities have been going down, but they saw some strength this past week. Broad market, here's the CRB index. Flattened out this week, but still in a longer-term uptrend. Oil it actually fell back a little bit after the things in the Middle East kind of calmed down, but we did go up almost 2% on the week to $83.85 a barrel. Then looking at copper, and if we see stronger than expected economic reports, you're going to continue to see copper going up. because it's a barometer looking out into the future of the economy. And when this is going up, things tend to look better, economically speaking. And that's why we're seeing this really going up. And it's it's still in a downtrend here. That's kind of strange, but we could see a golden cross here pretty soon. But it's in an uptrend on the daily chart. And the dollar, which also can pressure stocks, it's been holding up fairly well. And of course, people say, well, the dollar, it's a fiat currency, which means it's not backed by anything. It just means that when you compare it to the British pound and the euro and the Japanese yen, right now it's the least crappy of the crap that's out there. And so it's been holding up a little bit better. Gold is continuing to be in an uptrend, even though it has pulled back. It fell 2% this past week. Silver is also in an uptrend and was down 5% on the week. And then looking at interest rates and bonds, total bonds, we're still in an uptrend, but we've really been falling back and we're coming down to the 50-week moving average. But longer term, we're still seeing where stocks are outperforming bonds on a monthly chart. And we're actually finally turning back to looking more negative. When we take the 1 month yield and subtract the 3 month yield, we should always get a negative answer here. Well, we were getting a positive one for quite a while. Now it's finally going back to looking more normal. Here's a daily chart of the yields. You can just see by giving this a glance that we've been going up with interest rates. Here's a weekly chart looking internationally where we have the US and UK rates. They're the highest, and they went up this past week. German rates went up and Japanese rates went up. That's the red line. And then I've been showing this for quite a while now too, for a number of months, where we topped out at 5% last October and then started to come down. They're wondering if something bad was going to happen after that. We don't know at this point, because there's been other times on this chart when we spiked and went down and nothing bad necessarily happened. And then this also kind of shows that same thing where we really spiked up. This takes, when it says real rates, that's taking inflation into account. That's why you see this a little bit lower here. And again, I've been showing this for quite a while, but we're to date not really seeing anything massively negative develop. Some relative studies. First, we look at an intermarket analysis chart where oil's still doing the best, followed by gold. Now, stocks have reclaimed third place, where the dollar is now in fourth place, and then bonds based on price are negative. When we look at a ratio between the NASDAQ 100 and the S&P, they're both doing well, but they both have been under pressure lately. But we did see a little bit of a tick up with the NASDAQ 100 outperforming the S&P this past week. The S&P 100 is still doing quite well when compared to the rest of the S&P 500. Growth to value, this is buy low, sell high. That's growth. Value is when the market tends to get more defensive. And we're kind of chopping around, even though in a longer term basis, growth is still outperforming value. Gold came down when compared to stocks. Stocks outperformed gold this past week, and it's still in a longer term downtrend with this ratio. And then gold to the dollar, since the dollar's been holding up a little bit better than gold, we saw this coming down slightly. Bonds continue to underperform stocks, even though a week ago they were coming up to this moving average. Now they're starting to decline again. And we look at low volatility stocks, which are more defensive. That's what folks get into when they're afraid the market's going to decline, or they're getting in more of a defensive nature. When we compare it to the S&P with a weekly chart, showing that the low volatility stocks are really underperforming. Discretionary is still in an uptrend compared to staples, but it's really been pulling back, even though it bounced up over 2% with this ratio this past week. Energy, which is still in a downtrend compared to the tech, it has been pulling back, but lately it was really starting to break out to the upside. Looking at our trends, the NYSE breadth thrust, that was triggered on October of 2022, and we're still working off of that. This is one that I've really been hitting in the daily videos. We're potentially going to see a new ZWAG NYSE breadth thrust. The way this works is when we get an extreme negative reading, and then within 10 trading days, we power up out of that and get an extreme positive reading. And this was developed by Marty ZWAG. And that tends to be very rare, number one, and very positive for stocks, number two. Well, we saw one triggered a little over a year ago. So this one's pretty much fallen off the books. Last October, we saw another one triggered. And to see any of these is rare. To see them so close to each other is even more rare. And as I've been saying in the daily videos, this is the cow's still alive rare. That's how strange it is to see these. Now, we went extreme negative with this. and we're still within the window. Now we're going to lose that window this week, but if we can bolt up and get above this red line and get an extreme positive reading, which means we're going to have to see some real strength in the market, we might see another swag NYSE breadth thrust triggered. Now, this is also 1 day behind, so this doesn't take into account Friday's action. And we probably went up with this, but we don't know how far up we went with this whole indicator. Then the Zahorchak still is on a full-on buy signal. Longer term, we're still above this long-term trend line going back to the 1987 crash. Here's a further blow up here where we're getting a little bit of a bounce here above that trend line. And we're coming down, but we're still above zero with our NYSE new highs minus the new lows. And then this is a 50-period moving average of that to give us a longer-term perspective. This is a 50-period moving average of S&P 500 new highs minus new lows. And this has been declining, but it's still above zero. So longer term, it's still positive, even though it has been showing weakness. And we look at the NASDAQ 100, it's coming back up to the underside of this long-term trend line going back to 2009. And we're still doing okay here with our NASDAQ 100, that's growth, versus Dow, that's more value, ratio, where the perma bears, they thought we were going to come right up here and then just fall apart. Well, we're still just dangling around very high readings now. Similar chart. We compare the QQQs, the NASDAQ 100 to the small caps, and this came back up. We're close to these high readings right now because the Qs had a pretty good week and the small caps didn't have a very good week. So that when that happens, this ratio goes up. We're still going up, but showing a little bit of weakness here when we look at the cumulative value for new highs and new lows for the NASDAQ. And we're dropping below zero with our daily score here. And if we stay under zero for very long, that's going to turn this down and make it look more negative. And we're keeping an eye on the 3-month yield to see if it really starts to drop. That's what happened when the great financial crisis happened. We're just waiting to see if something like that develops. So far, we're just kind of going sideways here. My gosh, it's at 5.39% for the 3-month yield. And you got the 10-year at 4.67%. My goodness. Seasonality, and I put in another red box here because we're starting to finish out with April and going into May, where we do see some positive seasonality going into the last part of April. The last day in April tends to be negative, but then typically we see some not really big declines, but we do see negative seasonality through the month of May. And what I've been pointing out in the daily charts is we're seeing value doing better. We're seeing the market pulling back. We're seeing below average volume. Is the market turning more defensive because it sees this weak seasonality that we could go through in May? I haven't read that anywhere. I came up with this conclusion on my own. And it's not even a conclusion. It's a hypothesis right now. Just wondering if we can kind of try to explain what's been happening. Then as we get towards the latter part of May and then into the summer months, this is when we tend to see more strength on a seasonal basis during an election year. Another chart that also we're pretty much sticking to is when we compare 1982 and what happened after that with what happened in 2023. And even with the weakness, we're still actually continuing to outperform historically what has already happened. And then looking at April, going back to 1950 during an election year, we're up 11 out of 18 times. We're down 7 out of 18 times with a usual return of 1.3%. Then looking at all the months, going from 1950 to 2023, we're up 71.5% of the time with an average return of 1.5%. Then April tends to be a solid month, no matter how you look at it. And April's also good when you look at the monthly returns going back to 1950. On a global basis, April ends up being the most positive month of the whole year. And then near the middle part of April, that's when we should have seen the weakness go away. And then we tend to see more strength going into the latter part of the month. And we still have a few trading days left. And then this is updated. Weakness now isn't abnormal, which means weakness is normal. This is, I'd say, a double negative there. But we were seeing some weakness. We're actually underperforming the average. Well, if we do see some more strength coming back in, we're going to have to work just to get back up to this average. And this is what they're showing for May. overall. And so this is the negative seasonality that I've been seeing. We don't know if we're going to stick to that. We could totally deviate the way we've done in the past, but this is something that I just use as a guide, just to give us some heads up as to what, to me, it's better than trying to forecast things. At least you can see what, on an average basis, what the market was inclined to do during different parts of the year. And then Tom Bowley, we're coming into the latter part of April where he tends to see positive returns based on his research. And now we're looking out a little bit into May, where we do see a pretty good track record. It's up 13 out of 18 times and down 15 out of 18 times, but the returns are pretty minuscule overall, only up 0.1% during an election year going back to 1950. So thank you. I really hope you found this helpful. I hope you have a really good weekend. There's still a few more videos that I will be posting over the weekend, so I hope you decide to check those out. Even if you don't, I hope you have a great weekend nonetheless.